Welcome back to Wealth and Wisdom. In part 1, we covered the basics of investing, including how to get started. If you missed that, make sure to check it out first. Today, in part 2, we're going to take things a step further and focus on building a solid investment strategy. Plus, we'll talk about how to manage your investments over time so you can reach your financial goals. Let's dive in. Before we can create a strategy, we need to go back to the fundamentals. What do you want your investments to achieve? Is it long-term growth for retirement? Or are you investing for a shorter-term goal, like buying a house or funding your children's education? Defining your goals is critical because they will directly influence your investment strategy. For example, if you're planning to retire in 30 years, you may be able to take on more risk with stocks. But if you're saving for a home in 5 years, you may want to keep things more stable by focusing on bonds or ETFs that don't fluctuate as much. So take a moment to think about what you're investing for. Once you know your goals, you can create a strategy that matches your timeline and risk tolerance. Now that you have your goals in mind, let's talk about risk tolerance, the level of risk you're comfortable with. Remember, investing involves risk, and the key is to balance risk and reward. A common approach to managing risk is asset allocation. Asset allocation is the process of dividing your investments across different asset classes, such as stocks, bonds, and cash. The idea is that by spreading your money out, you reduce the risk of your portfolio taking a big hit if one of your investments doesn't perform well. For example, if you're young and have a long-term horizon, you might allocate more money to stocks since they tend to offer higher returns over time, though they can be volatile. But if you're older and getting closer to retirement, you might allocate more money to bonds or other lower-risk investments to preserve your capital. There are several different strategies you can use to approach investing. Here are a few common ones. Buy and hold. This strategy is all about long-term growth. You buy investments and hold on to them, regardless of short-term market fluctuations. The idea is to let time work in your favor, benefiting from the overall market growth. This is often used with stocks, index funds, or ETFs. Dollar cost averaging. With this strategy, you invest a fixed amount of money at regular intervals regardless of the market's performance. This helps smooth out the highs and lows of the market by buying more shares when prices are low and fewer shares when prices are high. It's a great way to reduce the impact of market volatility. Value investing. This strategy involves looking for investments that are undervalued or on sale compared to their intrinsic value. This requires research and patience but can be rewarding in the long run. Famous investors like Warren Buffett use this strategy. Growth investing. Growth investors look for companies that are expected to grow at an above-average rate. This strategy can be riskier since growth stocks are often more volatile, but they can offer high returns if the companies perform well. One of the most important principles of investing is diversification. Diversifying means spreading your investments across different asset classes, industries, and regions to reduce the risk of loss. You don't want all your eggs in one basket. Let's say you only invested in tech stocks. While tech has seen tremendous growth in recent years, it's also one of the most volatile sectors. If the tech industry experiences a downturn, your portfolio could take a big hit. By diversifying, investing in a mix of stocks, bonds, international funds, real estate, and maybe even commodities, you're helping protect yourself from the volatility of any one sector. One of the best ways to diversify, especially for beginners, is through index funds or ETFs, which automatically spread your money across a wide variety of companies. Investing isn't a set-it-and-forget-it process. Over time, the value of your investments will change, and your portfolio may become unbalanced. For example, if the stock market has a great year, and your stocks grow significantly, your portfolio might end up with a higher allocation to stocks than you originally intended. This is why rebalancing your portfolio is so important. Rebalancing means adjusting your investments back to your original target allocation. So if you were aiming for 60% stocks and 40% bonds, but now your stocks are at 70%, you'll want to sell some stocks and buy bonds to get back to your desired balance. Rebalancing helps you maintain your risk tolerance and keeps your strategy aligned with your goals. You don't need to do it every month. Typically once or twice a year is enough, but it's a crucial step to keep your investments on track. Finally, let's talk about one of the hardest parts of investing, staying the course. The market will go up and the market will go down. It's just part of the journey. During times of volatility, it can be tempting to panic and sell off your investments to avoid further losses. But this often leads to missing out on long-term gains. The key is to stick to your strategy. Don't let short-term market movements dictate your actions. Remember, investing is a marathon, not a sprint. As long as your goals and strategy haven't changed, your best move is often to stay invested and ride out the storm. That's a wrap for part 2 of our investing series. Today we covered building a solid investment strategy, managing your portfolio, and staying disciplined in the face of market fluctuations. By defining your goals, understanding your risk tolerance, and diversifying your portfolio, you'll be on your way to building wealth for the long term. Thanks for watching. Don't forget to like, subscribe, and hit that notification bell so you won't miss part 3. In the next video, we'll talk about common investing mistakes and how to avoid them. Leave any questions or thoughts in the comments below. I'd love to hear from you. Until next time, keep investing smart.